JPMorgan sees storm clouds and another bank with an outright warning. Let's talk about it on the weekly update. Okay, friends, so let's talk about JPMorgan's warning. Here's what you need to know. First up, JPMorgan's comments gave us another look into the economic storm, and this is a little bit of a different view than what we've seen previously. So we have to talk about the share price movement in JPMorgan yesterday. Now, this is the news review where typically we don't look at market events. However, the news was so large that there was an immediate impact to JPMorgan stock. I think yesterday, this is a candlestick chart, as you can see, but yesterday we started somewhere around 220 and maybe we finished somewhere around 205-ish yesterday. And, at the very worst, every bit of a 7, 8, 9% drawdown for JPMorgan. Really big stuff. So what did they tell us? Well, here's the headlines the day after. Investors didn't like what JPMorgan sees in 2025. Yeah, if that ain't an understatement. But basically what happened, Daniel Pinto, he's the COO of JPMorgan Chase. And what he did was he told analysts at an investor conference that their estimates of JPMorgan's 2025 earnings are too high. Now, this is important because remember, the stock market really isn't linked to the economy. They do different things at all times, but it's earnings season. Earnings is that point in time where the distance between the two just gets a little bit closer. And so when someone senior at JPMorgan comes out and says, hey, our earnings aren't going to be as good, the way that you can interpret that is to say, okay, that means that this economic storm that we're seeing is starting to bite, and it's going to bite in corporate results. Specifically, what he was talking about net interest income in 2025. And basically the way you can think about that is it's profitability on loans. So what JPMorgan is saying is they're saying, hey, our loan portfolio, loan growth is not going to be as profitable next year. And yesterday, we also got some interesting commentary from Ally Financial. Now, JPMorgan is important and market moving because in my perspective, they are the absolute best bank. They're generally tend to be the only bank I ever recommend if people want to have banking exposure. Ally Financial is a much smaller player, and they're primarily consumer banking. So things like credit cards and auto loans. And what Ally said yesterday is also something that I think investors want to clue into. What they said was, our credit challenges have intensified once again at an investing conference. And they're talking about some key problem areas for the bank, including the retail auto loans. Delinquencies on these things going past 61 days, and the amount that delinquent has grown in the last 2 months. And basically, what he said, this is, who is this? Oh, Chief Financial Officer. So the CFO basically said, hey, this delinquency is going to expand. And they also said that their credit card portfolio is stable, and that the bank had to issue a lot of curtailment when they saw elevated charge-off rates in 2023. So what a charge-off rate is, that's basically credit card debt that they're not going to get back, so they have to send it to collections. And what they're saying is we saw a lot of pain on the credit card side in mid-2023, so we had to curtail our lending. And this is what's important because we've talked about the economic storm previously, mainly as sort of like a demand phenomenon. Consumers just weren't buying as much or in the same way as possible, or in the same ways they did in the past. This, I want you to think about it in a supply context, the supply of money. When banks tell us, hey, we're going to curtail lending in credit cards, or we're seeing some problems in auto loans, what that tells us is they're going to do less of that lending going forward, or it's going to be more difficult to get a loan. And so what this does is, in the future, after these things happen at the banks, even if consumers want to buy, there's going to be several classes of goods that they can't buy simply because the financing won't be there. So this is sort of like a supply of money thing. It's a different aspect of the economic storm. One final piece I thought was interesting. This won't be unfamiliar to you if you're a faithful follower of the channel, but JPMorgan analyst, I think this is Matt Boss. I think he's the retail analyst. He came out and he was talking on CNBC. I think it was yesterday, if not yesterday, then the day before. He was talking about retail's selective recession. Now, this should sound familiar to you. We've been talking about half session for quite some time now. Maybe about a month and a half ago, we first talked about this. I think it's really cool starting to see these ideas sort of hit the market more broadly. Lets me know, we've got a good viewpoint on things. So What does this all mean? What was JP Morgan's warning? Well, JP Morgan specifically warned about their profit expectations for next year, but I'm reading into this as this is an intensification of the economic storm. So the economic storm is getting a little bit worse here because now we don't just have demand. It's not just consumers getting tapped out. We're starting to see some dislocations in the supply of money. And typically those problems are a little bit bigger. Weak demand, you can cure that by lowering prices, maybe economic fears not being as large as what you were afraid of. Supply of money is a little bit one of those stickier problems. I expect as the economic storm continues to build strength, we're going to see more of this, not just from the banks, but I think we're going to see more companies come out and say, hey, your expectations for our 2025 earnings are going to be challenged. Now, that's all bad. Nothing we've talked about up until this point has been good. But remember, medicine is coming next week, right? We're going to start to see rate cuts coming in next week. I think September 20th is the Fed meeting. So we don't want to lose hope here, right? We don't want to read too much into this. It's not time to jump off the ledge just yet. But this tells us that when the medicine does start to come, we're going to need a pretty strong dose of it. So during this time, anytime we've looked at the economic storm, we want to focus on two things: intensity of the storm and signs that the storm is ending. What I can tell you this week is the storm is intensifying and we've got no signal yet that the storm is ending. And the medicine isn't working yet because we haven't gotten any. So there's really good reason why the Fed's going to cut rates. And I look forward to seeing how the economy is going to improve or not as a result of those. I'll see you this weekend for the markets review. Take care. Okay, friends, that was the video. Hope you liked it. If you found it informative, good, entertaining, I'd love if you could scroll down here beneath the video and give me a like there. It helps us out with the algorithm. And then if you want to be notified first of anything new that we upload to the channel, if you come over here, click subscribe, you'll be the first to know as soon as we upload anything. Appreciate it. See you soon.